Hello, good morning, good afternoon, and good evening. It depends upon where you're located at. Today, I'm going to discuss to you all about business combination, PFRS 3. Okay, this is a type of investment where there is a control or there is a decision making involved because there is a control over a particular asset, liability, or even in an equity part. Okay. I am Almucted J. Mandangan and my partner is Calvin Troy B. Suganab. What is a business combination? Okay. A business combination is a transaction or other event in which an acquirer obtains control of one or more businesses. Transactions, sometimes referred to as true mergers or mergers of equals, are also business combination as that term is used in IFRS 3. The most important element of business combination, there must be a acquirer, and that acquirer will obtain a control over the asset or net identifiable asset of a acquiree. Okay? So there are two methods of business combination or modes of carrying out the investment. First, we have the merger and consolidation. In the asset acquisition, we will talk about that later. Okay? So the most important thing or the most important definition of business combination is there must be a control. Okay? That's why it is a business combination because you acquired them to obtain a control on that particular asset, liability, or on the shares of another business. Next. Okay. Doing business. Doing business is something that you have an operation. There is an operation and there is a your main goal is to earn profit. So, acquisition date. There is an acquirer, there is a acquiree. As just like what I said, there is a acquirer. It means they acquired a net identifiable asset or acquisition of stock. Okay? It is important to determine the acquisition date because acquisition date is relative and very important for determining the fair values because fair values are very useful in determining the goodwill. Okay? Next. Modes of carrying out business combination, asset acquisition. Okay. In the asset acquisition, all the net identifiable assets are being acquired by one business. Okay? There are two types of asset acquisition. There will be a merger where A plus B is equals to A or B. Where one constituent will cease to operate or the one who acquired will will get the acquiree. Okay? Let's talk about the consolidation. In consolidation is A plus B will equals to C. Okay? Both will both will be ceasing to operate. Next, we have the modes of carrying out the business combination. Another types of business combination when there is a acquisition of stocks. Okay, this is an acquisition of shares, stock acquisition. However, when you the most important thing in the stock acquisition, you must acquire 51% of the shares. If you acquire the 51% of share, there will be a control. However, if 1 to 19% acquisition of stock acquisition, there will be that would be fair value through profit or loss or Fibonacci. If Other than that, if 21 to 49, it is a implication that it would be accounted for investment in associate with that we will talk about later. That we will learn in during second sem IAS 28 stock acquisition and identifying the non-controlling interest. There will be always a non-controlling interest. Not always, but when you talk about stock acquisition, there will be a non-controlling interest. Okay? In net identifiable assets, there will be no non-controlling interest. Okay? Because all of the assets will be acquired by the acquirer. Next, this is the advantage of the business combination, competition. Okay? When the two business will combine, one will cease to operate. Therefore, the competitors will be lessened. Second is the synergy. When you talk about synergy, 1 plus 1 is equals to. It means both competitors will merge. Therefore, there will be only one entity will operate. That's why it will become powerful because they will contribute their ideas how to become successful, a successful business. Second, it will cut the cost. Duplication of cost will cut off because there will be only one business will operate. Next, we will talk about the disadvantage of business combination. Monopoly. There will be an impact in the society when the two competitors will combine because there are tax implication. There will be a impact to the society to that matter. Closing down because of this one group or one business will cease, it will close down. That is disadvantage. Therefore, it will cease to operate. And overcapitalization. When there is an overcapitalization because of the two business will combine, there will always be an overcapitalization because of that asset. Okay? There must that's all. Next, illustration determining the existence of control. Mandangan Corporation acquires 58% ownership interest in Suganov's etc. ordinary shares. Okay? It means that 58% of ordinary shares. The rule is if the investment is 51% above, there will be a control. Here, it passed the requirements because it is a 58% ownership ordinary share. Therefore, there is a control by the number 1 example. Number 2 example, Christos Co. acquires 95% of CTT Intraday preference shares. The answer is no control. Why? Because it is just a preference shares. Because when you acquired a preference share, there is no vote. Only the ordinary shares will have the right to vote in the decision making of the management. Next, XYZ Corporation acquires 45% ownership interest in ABC, etc. XYZ has an agreement with JJ Corporation, which owns 10% of ABC, whereby JJ will always vote in the same way as XYZ. The answer is yes, there is a control over the ABC because as an agreement by JJG, XYB 45% plus 10% is equals to 55%, which is above 51%.
So good day to each and everyone. Today I will be discussing on the steps in applying the acquisition method. So here are the following steps. First is to identify the acquirer. Next is to determine the acquisition date, followed by recognizing and measuring the assets, liabilities, and non-controlling interest in the acquiree at fair value at the acquisition date. And finally, finding the goodwill or bargain of purchase or the difference between the consideration paid and net assets acquired. So first of all, in identifying the acquirer, we must first understand what is an acquirer. The acquirer is the entity that obtains control of the acquiree, while the acquiree is the business that the acquirer obtains control of in a business combination. In Pfrs 3, it provides the following guidance in identifying the acquirer. So, for you to understand, In a simple way, the acquirer is the one who has the largest portion between the combined entities measured in, for example, assets, revenues, or profit. It is also the one who initiated the combination and also the one who issues its equity interest. Now moving on to the next step. On acquisition date, the acquirer recognizes identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree separately from goodwill. Unidentifiable assets are not recognized. Examples of unidentifiable assets are goodwill recorded by the acquiree prior to the business combination, assembled workforce, and potential contracts that the acquiree is negotiating with prospective new customers at the acquisition date. Now, to qualify for recognition, identifiable assets acquired and liabilities assumed must meet the definitions of assets and liabilities provided under the conceptual framework at the acquisition date. Next, all assets are acquired and liabilities assumed in a business combination are measured at the acquisition date fair value. Separate valuation allowances are not recognized at the acquisition date because the effects of uncertainty about future cash flows are included in the fair value measurement. For example, the acquirer does not recognize an allowance for doubtful accounts on accounts receivable acquired on a business combination. Instead, the acquired accounts receivable are recognized at their acquisition date fair values. Now here we have exceptions to the recognition and measurement principles. These items are liabilities and contingent liabilities within the scope of IAS 37 or IFRIC 21, contingent liabilities and contingent assets, income taxes, employee benefits, indemnification assets, reacquired rights, share-based payment transactions, and assets held for sale. Now these items are not included in Pfrs 3 because they have other standards which are applied to them. Now here we have the recognition and measurement of goodwill or a gain from a bargain purchase. As you can see, this is the formula in obtaining the goodwill or bargain of purchase account. So in order to get the goodwill or bargain of purchase, you must first add the considerations transferred, amount of non-controlling interest, and fair value of previously held equity interest, less the net assets recognized from the acquiree. Now here we have an example of a business combination. These are the recorded assets and liabilities of seed company. As you can see, there are two values, the fair value and the book value. The value that we will be recognizing is the fair value, of course. In acquiring the net assets of the entity, we must find the difference between the total assets and the total liabilities of the entity. Now, Pete pays $1,500 to seed company to acquire all of its assets and assumed all of the liabilities. To get the goodwill, we must use this formula. Considerations transferred, which is $1,500, and non-controlling interest, which is 0, because Pete Company had acquired all of its assets and assumed all of its liabilities. Previously held equity interest, which is 0, so a total of $1,500, less the fair value of net identifiable assets acquired from the acquiree, which is $1,440. So the goodwill will be $60. So that is all. Thank you for listening and have a good day.